Hey everybody, it is almost 2024. We're going to talk about some high yield stocks that could still be a bargain even after the market seems to have been doing really well. The Dow Jones just hit a brand new high. The Fed mentioned interest rates could drop, and everyone's buying again.
We're back,
So
baby. We are so back.
I know, apparently. So before we get into it, please take a minute, click subscribe to my channel, and check out the message you see on your screen for a message from my sponsor, The Motley Fool. You get the top 10 stocks to buy right now, and it's the best way to support what Tyler and I are doing here. So without further ado, we're going to talk about two stocks. Tyler is kind of an encyclopedia of stocks you might not have heard of. So I'm going to ask him to go first. Tyler, what high yield stock are you watching as we head into 2024?
So the one that's been on my radar, and sorry to disappoint, I think this one is maybe something we've already mentioned on this on your channel before, but I'm going to go with Equinor. It is the Norwegian state oil company. So large oil and gas production, a little bit of refining, a little bit of pipelines, kind of all the other things that are normally involved with the large national oil companies. Now, before I get into it too much, I should mention this is an oil company. Oil company stock prices are going to move with the price of oil. So just keep that in mind. Like I'm focusing more on this company, on its earnings potential and what it can do based on the quality of the business rather than, I don't necessarily know where oil prices are going to go in 2024. But here's why I like this business. The majority of its assets are on the Norwegian continental shelf, which is one of the most, I wouldn't say like productive in terms of like the most, oil production, but is a very economical place to do business. If you look at Equinor's investor presentations or its annual reports, it will show that the Norwegian continental shelf, basically their break-even prices, like how much before they start making a profit, is $25 a barrel. So even at today's prices, which are a little bit down, I think we're right around somewhere in the 65 to 75 range. That's still a pretty good profit margin. And it's also one of those businesses where it doesn't feel the necessity to grow its production extremely fast. They're more or less in the lines of we just want to extract the most amount of value out of this as possible and return it to shareholders or try to invest in our offshore wind programs because we see that as the future. Now, because oil prices are where they are and based on the operations that the company has right now, it has been throwing off gobs of cash. Right now, it has both a quarterly dividend and a special payment dividend, kind of that special dividend on top of the quarterly. And based on the next 12 months, based on those special dividends and its current quarterly, we're looking at something about a 13.8% dividend yield. It currently trades for about 5.7 times trailing earnings. That could go up and down based on oil prices, but still, that's a relatively cheap valuation. And on top of that high yield, it's also still buying back stock and paying down debt. This thing is throwing off monster amounts of cash right now, and it doesn't really know what to do other than give it back to shareholders some way or the other. And so, with that in mind, again, could go up and down because of oil prices. I'm not too focused on that in 2024. I'm not a oil price prognosticator, but based on the earnings potential of this company, even at today's prices or even lower, I think this is a really good high yield opportunity for people and one that I own personally.
Yeah, that's definitely a different choice than mine. I'm going with a company called Ally Financial, which I'm sure you've heard me talk about before. Ally has been a publicly traded company for 10 years as a standalone business. It was formerly a part of GM. It was the GMAC Financial division. So it shouldn't surprise anybody that its biggest business is auto lending. And I've talked about the company in the past for a few reasons because one of its margins, Ally originates auto loans at roughly 10% interest. I'll talk about that more in a second on average right now. And its cost of capital is a lot less than that, around 4%. So pretty big profit margins compared with other banks, even when you factor in losses. The recession fears have really been overblown in this stock. The people have been expecting higher loss rates because of economic worries. People won't be able to pay their auto loans, things like that. That really hasn't materialized to a significant spike over pre-COVID levels. Ally has been a big outperformer lately. Since the Fed announced that it's projecting 3 rate cuts in 2024, as we mentioned earlier, the stocks have kind of been off to the races, and Ally is one of them. But it's still trading at a pretty attractive valuation. It trades for less than book value, just slightly now. Trades for about 12 times forward earnings. It still yields a little less than 4%. So not exactly a high dividend stock, but if we were to rewind the clock back in 2021, we would have called this a high dividend stock at that. So the reason I'm emphasizing Ally today, even though it's performed well, is because I don't think the price really reflects the potential in a falling rate, soft landing environment. For one thing, its cost of capital will go down tremendously if rates fall. Ally has $153 billion in deposits. That's more than its overall loan portfolio. So most of those are in the form of high yield savings accounts. As rates fall, the yields Ally pays will fall pretty quickly. But the yields it's getting from its portfolio are largely going to stay the same. Over time, some new auto loans will come onto the portfolio, but for the most part, the yields will stay the same. Margins could expand dramatically as rates fall. And that's even more true right now because the average, auto loan rate is still near a record high. They really haven't come back much. In the third quarter, the average auto loan originated by Ally had a 10.7% yield. And that's with almost half of them being issued to borrowers in the highest credit tier. So I'm a big fan of Ally right now. I think it could be a big winner as interest rates fall. I think fears are still kind of overblown. Banking fears are still kind of weighing on the industry. Ally, by the way, has about 92% of its deposits FDIC insured, so it doesn't have to worry about any of those. Um, I own a bunch of bank stocks. Well, three big ones in particular. Ally is one of them. This is the one I think I am going to add to as we head into 2024. Tyler, do you have any opinion on Ally or banking in general right now?
I have more of a question than
Sure.
a response. But so you talked a lot about kind of the potential of growth, but just on the protection to the downside, I guess is the thing that I just want to look at both sides of it. Where what is the bad case scenario for Ally in terms of, I don't know, maybe rate cuts don't come as soon as we expected, or credit quality deteriorates? What kind of profitability do they have right now where they could kind of bear a decline in their current net interest spread or something like that?
Yeah, and that's a good point. Ally is one of the few cases where we've actually seen net interest spreads fall a little bit as interest rates rose. With a lot of banks, it's been the opposite. Um, and that's a reason the stock is still almost 40% off the highs. It's because, when you get an auto loan, what's the average auto loan? 5, 6 years maybe right now. So say 5 or 6 years ago, Ally was making auto loans that were at 6 or 7% interest. Now its deposit accounts pay almost 5%. So the spread it's getting against the older parts of its loan book are very low right now. So if rates stayed high or even increased from here, you'd see a lot more margin compression. I'd have to actually run the numbers to see how much of that they could handle before profits really went away. But we've seen quite a bit of it. Ally's, earnings per share have dropped considerably, and a big reason of it is this margin compression we've seen. So that's a very good point. It could go the other way if the Fed is being a little too optimistic, which according to the interest rate video we did last week, you think they might be a little too optimistic given 3 rate cuts, especially if we do get a soft landing in the economy. So, uh,
I I don't know when it comes to that stuff. I tend to believe what they say, and I feel like there's been a lot of people who've been, you know, oh, they're not going to do that, and then they did it, and now we're here. So, but
yeah.
yeah, no, that makes a lot of sense.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.